Do you own your own business? Are you self-employed? How do you take money out of the business, and how is it taxed? What's the difference between taking a wage or a salary and a distribution? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so if you're self-employed, the question is sort of how do you pay yourself, right? And it sort of, there's different gradations, different degrees of self-employed. You could be just a handyman and doing stuff totally on the side for cash, and make sure you're doing that right, okay? Keep everything above board. Or you could be really entrepreneurial and start lots of businesses, run them, and then sell them, or have someone else run them and then move on to the next thing. There's all sorts of gradations, okay? But one of the decisions that you've got to make in running or owning your small business is, how do you want the entity taxed? Okay, and this is going to flow into, all right, well, when you take money out of the business, how is it taxed? What's the difference between a wage and a distribution, which is the primary sort of crux of today's discussion. When you are just starting a business, if it's just sort of, hey, handyman, I'm not doing much, whatever, you're probably just going to choose to have it be taxed or structured as a sole proprietorship, okay? If there's any liability at all, which is basically anything, okay, if there's any risk of you doing something that harms someone, or maybe someone's offended by or whatever, and they want to sue you, you should structure it as an LLC, okay? So you limit your liability. But you can have it structured as a sole proprietor, where all of your revenue is listed on your normal tax return. Just they add a new schedule to it, Schedule C. All your revenue's listed there, and then you list out all your expenses for the business, and then the profit, okay, is what flows over to your actual 1040 tax return. It's taxable at the federal level, state and local if you have those taxes, and then you've got to pay self-employment tax on it, which is basically FICA times 2, okay? So that's how a sole proprietorship works, all right? And that's how that's taxed. If you go S corporation, okay, subchapter S. We're not going to get into C corps there. That's something totally different. Not going to talk about that today. But if you instead set up a business, and you're not just hanging a shingle, you're actually you're going to run this thing as a business, and you file subchapter S, okay. Well, then you actually file a separate tax return, an 1120S, okay, where you're doing everything you're doing on your sole proprietorship. You're listing revenue and expenses and all that sort of stuff, just with a little bit more detail. Okay, and then the profits, the net income of that subchapter S flows over to each owner's 1040 or tax return via something called a K1. Sorry for all the jargon, my goodness. Flows over to your tax return based on your K1 form, and that you've got to include on your tax return, and it's subject to federal and state and local taxes if you pay those. Under current tax law, you may also be eligible, not everyone is, but you may also be eligible for a qualified business income deduction on that income from what comes over on your K1. So at a high level, that's how those two different entities, sole proprietorship, S corp, are taxed. Now, if you do an LLC, you get a choice, okay? You get to choose, do I want to be taxed as a sole proprietorship, which if you're just making a couple $1,000s a year, if it's not a big operation, that may make sense. Or you can say, I'm an LLC, but I want to be taxed like a subchapter S corporation. And that's great. That would make more sense if you've got higher income and it's more sustainable. All right, so that's a cursory overview of those different sort of self-employed entity structures. Now let's get into it, okay? As the business owner, how are you going to draw money out? And how is it taxed, okay? You can draw dollars out as a wage. You can actually pay yourself, put yourself on payroll. Now, tricky to do if you're just mowing lawns and you mow the neighborhood and whatever, and you don't make much money, okay? If that's your side hustle that doesn't have a lot of income, you're probably not going to structure yourself as an S corp. You're probably not going to add yourself to payroll, okay? But say you're a subchapter S corporation and you're working at the business, you could pay yourself as an employee through payroll. In fact, there are laws that suggest, and I'm using my own terminology here, that if you're working in the business and if you own the business, you need to pay yourself a fair and reasonable wage. You should. When you take that wage, all right, you're going to have a W-2, you're going to get a paycheck, all that sort of stuff. Even though you own the business as well and have to report profits, you're going to report that wage as you would if you worked for anyone else, okay? You're gonna have to include that on your 1040 tax return. You're gonna pay federal tax. You're gonna pay state and local taxes as well, if that's applicable. You're gonna have to pay FICA. That's going to come right out of your paycheck. And then the business will have to pay payroll tax, which is also FICA, right? So basically your wages that you pay yourself are going to be subject to federal and state tax as well as self-employment. It's just FICA and payroll tax, okay? Just like it would if you were just a sole proprietorship, all right? So that's how the taxes work for a wage. The good news is your wages count towards your Social Security income, okay, or Social Security wage base. So your Social Security future calculations can be based on those wages. Now you've got to determine if that's enough for you, okay, because you're going to have to pay that Social Security tax on those wages. You also have to pay maybe unemployment taxes on those. You've got to pay workman's comp on those wages as well. It costs money to set up payroll and to file 941 tax returns, that sort of stuff. So it's a little complicated, but that's how your salary, that's how your wage is taxed as a small business owner. The other way that you can draw money out of the business as a self-employed individual, and by the way, you do this as a sole proprietorship as well, is a draw or a distribution or a dividend. It's the same thing, the 3 Ds. It's the same thing. You just cut yourself a check. You basically what that is you taking a withdrawal of the cash in the business, but ideally out of the profits, right? Out of the profits of the business, you're taking a draw. And you've got to record it as such in your QuickBooks, your accounting, whatever, because they've got to make sure that your draws are consistent with your basis. Otherwise, there's other calculations. This video is not about all that. But the point is, as a small business owner, and let's continue to stay with the example of Subchapter S, you are either drawing money out and paying yourself a wage, or you're drawing money out as a draw, distribution, dividend, okay, of the profits. How is that taxed? Well, it's essentially like you're drawing money out of the profits. And I told you, as a small business owner of an S Corp, you're going to have to report all of those profits on your tax return on, I believe it's line 17, unless they're going to change it again this year. We'll see. The tax that you pay on that is going to be federal tax, state and local tax, but no FICA, okay? And you might even be eligible for a qualified business income deduction. If you're doing the math here, it's much more advantageous for you to take a draw, a dividend, a distribution from your S Corp than it is to pay yourself a salary. You're going to pay less tax by doing that. The trade-off, though, is that you're not paying in Social Security taxes on your profits from the business, and therefore they don't count towards your income when calculating what your Social Security benefit would be. Okay, so that's something to be mindful of. You're avoiding a lot of tax, but then you don't get the trade-off benefit that tax is supposed to cover. If it's this lopsided, why wouldn't everyone just take a draw from their business and never take a salary? It's essentially illegal to do that. You've got to pay yourself a fair and reasonable wage. And is the IRS going to audit you on this? I don't know. They very well could, okay? And so you're going to want to make sure that you're working with your CPA and your CFP to craft the right strategy here. We've seen lots of CFPs just blindly say, pay yourself up to the Social Security wage base. Why? What's the reason? I don't know. It just seems like the right thing to do. Or to maximize Social Security. Well, is that what your intent is, to maximize Social Security? And if you do that, the profit's just really little, or is that the best approach? Typically, I have seen CPAs alone struggle to give great advice here. Now, on average, certified financial planners who don't do tax planning, they're going to stay away from this topic. Those that do tax planning should be collaborating with the CPA and figuring out, okay, what's the right amount of salary to pay, and how do you structure that, and how do you structure withdrawals from the business. One of the ways that we love to do it is, all right, let's calculate that fair and reasonable wage. okay? And of that wage that you put yourself on, your salary, pay it a consistent amount every single month, have that cover all your 401k contribution, and have a lot of it, if not most of it, go to cover taxes. And then set yourself up with a consistent monthly draw as well of the profits, obviously making sure that the business is sustainable and profitable, you're not drawing too much money out, but draw the dollars out as a distribution or dividend that you need to live on. Okay, that's a great strategy, but owning a small business and running a small business, you know tax planning is just crucial for your, number one, to make sure you avoid surprises, which can happen a lot with businesses and the ebbs and flow of profit and revenue and all that and expenses. But two, making sure that you're paying the least amount of tax over your lifetime, okay? So work with your CFP that's doing comprehensive financial planning and is collaborating with your CPA to give you the very best advice. We've got a bunch of CPAs on our staff collaborating with our CFPs. So make sure that's what you've got. If you don't, you want to talk to one of our CFPs, we'd love to serve you. You can find us online, Korhorn.com, that's Korhorn with the K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.